a short video, we will discuss correlation. We will define correlation, discuss its uses within portfolio and risk management, and touch on some of the issues relating to using this tool. Correlation is defined broadly as a statistical measure that reflects dependence. Most analysts focus on correlation coefficient, which is the measure of the relationship of one variable to another. The calculation can be summarized as the covariance of two random variables divided by the standard deviation of those random variables. Correlation is used to determine if two specific assets' returns move in tandem with one another. The correlation of two instruments are used in numerous ways within the capital markets. Portfolio managers use statistical measurements to generate trading strategies, while risk managers use correlation to assist in calculating value at risk. Additionally, correlation can be used in option pricing, which has created a market for implied correlation. Correlation, as mentioned, is used in many ways, but in the capital markets. Portfolio managers will use statistical measurements to determine if specific types of security returns are correlated to their strategies to help benchmark their returns. When a hedge fund is highly correlated to an underlying index, for example the S&P 500 index, investors would have little reason to invest with that manager. Obviously, paying a high 2% management fee and a 20% incentive fee to receive the returns that one could receive by purchasing the SPDR ETF would be unattractive. Investors that have a multi-strategy firm which focuses on a number of investment strategies will also want to make sure the internal returns are somewhat non-correlated, not moving in tandem. By having a diversified portfolio of strategies, the investment manager generates the same benefit that a diversified portfolio of assets generates. Certain trading strategies rely on correlation as a way of picking products to trade. For example, in a long, short, or pair trading strategy, the investment manager will usually try to find assets that are highly correlated to assume market-neutral risks. A market-neutral risk is one in which the position does not have a high beta with the broader markets. Risk managers will also look at statistical measurements such as value at risk, which uses correlation as part of the valuation methodology. There are three basic approaches that are used to compute value at risk, though there are numerous variations within each approach. The measure can be computed analytically by assumptions about return distributions for market risk and using the variances and covariances across these risks. It is also can be estimated by running hypothetical portfolios through historical data or a Monte Carlo simulation. All measures of value at risk use historical data to some degree or another. In the variance-covariance method, historical data to compute the variance-covariance matrix that is the basis for the computation of VAR needs historical simulations. The VAR is entirely based on historical data, with the likelihood of losses computed from the time series of return. Both of these methods correlate historical returns and make assumptions about future correlation to calculate value at risk. Another type of use for correlation is its use in determining the price of certain types of options. Options on spreads or pair options require the use of a correlation coefficient to determine the value of the option. An option on Coke versus Pepsi or heating oil versus crude oil requires a correlation coefficient to calculate using a bivariate Black-Scholes model. A correlation coefficient for option pricing is an implied number, meaning that it is assumed similar to implied volatility. Correlation is used in numerous aspects of the capital markets, and investment professionals should use this statistic to help them drive their returns.